great. And next up, we have our partner session, Chainalysis. What cryptocurrency data tells us about new uses of money? So for today's session, we have Philip Gradwell, Chief Economist, Chainalysis.
Hello, Singapore Fintech Festival. I'm Philip Gradwell, the Chief Economist at Chainalysis, talking to you from London. And today I'd like to go through how cryptocurrency data can tell us about the future uses of money. But first, to introduce Chainalysis. Chainalysis is a blockchain analysis company, and we provide software, services, and research to government agencies, exchanges, and financial institutions around the world. And our data platform powers compliance, investigations, and risk management tools to help consumer access to cryptocurrency safely. We have over 300 customers across 50 countries, across our three key verticals of law enforcement and regulators, cryptocurrency businesses, and financial institutions. And we really see ourselves as the business that connects all of those three key stakeholders in driving cryptocurrency adoption. And we do that by processing the data that's on the blockchain so that we can actually understand where Bitcoin, Ethereum, and other cryptocurrencies are actually flowing between. And my job as the chief economist is to take a big picture view of that data to understand cryptocurrency uses and to try and predict what that might mean for the future. To set the scene, cryptocurrency in 2020 is seeing greater mainstream adoption. It's been quite a year for the asset class. There have been some big news stories. For example, MicroStrategy using Bitcoin as its treasury asset. We've seen hedge fund managers all over the world come out in support of the asset class. And companies like PayPal and Square are making ever greater efforts to make it easy for their customers to invest in cryptocurrency. And indeed, we've seen Bitcoin recently hit an all-time high. But adoption in 2020 is very different from adoption in the past. There are actual real use cases driving the adoption of cryptocurrency this year. That's very different from 2017, when a lot of the use came just from speculation and people hoping that the price would keep going up. This time around, we can see three distinct use cases across Bitcoin, stablecoins, and Ethereum. And I'm going to take you through the data that shows how they're being used. Bitcoin is being used as digital gold in an uncertain world. It's held by tens of millions of young people. So it's a huge opportunity for financial institutions to get involved with their customer base. Stablecoins are really programmable digital dollars. So they are at the forefront of digitization of assets. And I think they provide great lessons for what I call the social coins. These are cryptocurrencies issued by social networks, for example, Libra, recently rebranded to Diem. And then finally, there's Ethereum, which really is a platform for rapid innovation, acting more like a risky growth tech stock, which may succeed and may fail, but will certainly learn a lot along the way. So to dive into Bitcoin, which I call digital gold offered by fintechs, it's important to understand just how much Bitcoin is held by investors. Currently, it's 77% of the available supply. And investors started increasing their holdings of Bitcoin from mid-March this year. Remember, that was the time that financial markets across the world started to sell off as people became concerned about the economic consequences of coronavirus. The Bitcoin price certainly fell, but shortly after that point, we saw an increased accumulation of Bitcoin by investors. And you can see that on this chart. You can see the orange line is the amount of Bitcoin that's been held by investors, growing from zero in 2017 or normalized to zero in 2017, showing that an extra 3 million have been acquired by investors since the start of 2017. And we can see how that orange line suddenly gets much steeper after mid-March of 2020. And we can contrast that with the Bitcoin that's held by traders. This is the Bitcoin that is available to buy if you were to go into the market today and buy some Bitcoin. We can actually see that that's now below the level that it was at the start of 2017. And it is this interaction between high levels of investor demand and a shortage of supply that's available to buy that is causing prices to really ramp up at the moment. We can also look at the on-chain data to actually understand the types of investors that are buying Bitcoin at the moment. We can look at how Bitcoin moves from the addresses of the Eastern Asian exchanges into the accounts of North American exchanges. And what we've seen is that in the current price rally, it really is North American exchanges that are receiving flows from Eastern Asian exchanges. And the reason why Bitcoin might move from one exchange to another is because that's where the new demand is. Those Bitcoin are going to find a buyer, not so much in the Eastern Asian exchanges, but actually in North America, which is an interesting observation for all of you sitting in Singapore. I believe that this rally has been driven by that North American demand, not because there is not demand elsewhere in the world, but because it's been much easier for North American investors to access Bitcoin than it has been in the rest of the world. We can also see that actually this rally has been driven by the institutional investors. They've really entered the current market to a much greater extent than they did in 2017. You can see that here on this chart by looking at the number of $1 million plus withdrawals from exchanges. And we can see that that's increased 180% in 2020 so far compared to the whole of 2017. So there are a lot more people who are making big ticket purchases of Bitcoin and taking it off exchanges to store themselves. Another key way that investors are getting involved in Bitcoin is through Fintech apps such as Robinhood or Square or PayPal. And the growth of this has really been impressive. For example, Square's Cash App generated $1.63 billion of Bitcoin revenue in the third quarter of 2020 alone. And that is an 11x increase year over year. So this is driving a huge amount of revenue growth for these companies. But it's not just a story of investment. We can also look at how Bitcoin moves around the world. And we actually see that it's quite a global asset. There are strong local markets, in particular Eastern Asia and North America being the largest. But Bitcoin is also sent over borders in really quite large amounts. Indeed, 42% of all on-chain flows since the start of 2018 have crossed these large regional borders. We can also look at the data and understand what the grassroots adoption of cryptocurrency is, beyond just the activity of buying it and holding it for investment. And when we measure this, we see that there's actually the greatest use of cryptocurrency is occurring in countries like Ukraine, Russia, Venezuela, and China. So not only is Bitcoin this digital gold that you can invest in this time of economic uncertainty, but it's also being used to transfer money across borders and has this much greater grassroots adoption in a range of countries. So now turning to stablecoins, which I think of as digital dollars, and the data shows that they are really used for personal transactions, particularly in Asia. Now, over $20 billion have been digitized as stablecoins, and that's grown 3.8 times in 2020 to date. That's a phenomenal growth. And $20 billion of assets under management would make stablecoin issuers a medium-sized global bank in terms of assets under management. So these are large sums of money. Tether is responsible for 3/4 of all the stablecoins that have been issued, followed by USDC, which accounts for 17%. So really the stablecoin market is dominated by those two. And stablecoins are moving billions of dollars of value on the blockchain every week, $31 billion on average in the last 3 months. And that's up from $1.6 billion per week in Q1 of 2020. So again, enormous growth in the use of stablecoins to make transactions. 63% of that has been on Tether and 30% on USDC. So again, those two really are the key stablecoins. And Tether, if we look at the time zone pattern of its transfers, we can see that it's primarily used in Asia. So Tether is shown by the orange bars here, and you can see that they're low when people in Asia tend to be asleep, and then the number of transfers increases as the Asian business day starts, goes down again when it ends. This is in contrast to USDC, which has the opposite pattern, denoting American usage. And those Tether transfers, many of them are used to trade cryptocurrency, because Tether is frequently the other side of the pair in a cryptocurrency trade. But Tether has increasingly been used as a payments network, with 33 million transfers by individuals for less than $1,000 per transfer in the last 12 months. That is a huge number of transfers to be made on this asset. That, for example, is larger than TransferWise, a very popular way of moving money across borders. And so almost out of nowhere, this huge payment network has arisen primarily in Asia. But Tether is not just used for trading or as a payments network. People are also now starting to save in Tether. And we can see this because we can understand the wallets that tend to be illiquid. They tend to hold on to the Tether rather than circulate it back into the crypto economy. And we can also look at how long it's been held for. And there's $2.2 billion worth of Tether, around 10% of the overall supply, that's held by these savings wallets and has been held for more than 3 months. So that's a good amount of Tether that people are just keeping there as a store of wealth. And I find that fascinating. People may be swapping from their national currencies and instead deciding to hold Tether. The next cryptocurrency I want to talk about is Ethereum, which I think of as the largest financial incubator in the world. I'm sure if you work at a financial institution, your company has a Fintech incubator somewhere. Perhaps the company gave seed investment money to 10 or 20 startups, and you sort of put them in a room and give them some mentoring and give them a couple of years, and you see what ideas they come up with. And sometimes it works and sometimes it doesn't, but it's certainly an involved process for financial institutions to do. Well, you could just go and look at the activity that's happening on Ethereum, where for free, over 2 million people a month are actively using the blockchain. And really, they're often using it to experiment with new types of financial services. You can see just how active Ethereum has been in this chart. In yellow is the number of monthly active entities on Ethereum, and in orange is the number of monthly active entities in Bitcoin. And really shortly after Ethereum got started, the number of active entities rose above that of Bitcoin and has stayed above since then. The first wave of use was initial coin offerings, or ICOs, which, while they ended up in a lot of get-rich-quick schemes, at the time they were envisioned as a way to allow anyone to invest in any project wherever they were in the world. So really opening up a level playing field for venture capital. More recently, Ethereum has been the platform for decentralized finance, or DeFi. And that has attracted $14.5 billion of liquidity in a very short space of time. DeFi, it is a mysterious sector. It's mysterious because it moves so fast. But I think that's part of its magic. Because these are open experiments in trying to create a new financial product, they are open to this evolutionary pressure where one project starts, it may not be fully thought through, so it might fail, but then someone else will be able to look at that open source code and improve it and try again. And we're going to see so many iterations and fast cycles of innovation that something useful will come out of this. And I think the one thing that has come out of it so far that has been very useful is understanding how you can actually incentivize people to provide capital for your financial product. This liquidity, this $14.5 billion of liquidity, has been committed to DeFi products because the people who are pledging the collateral aren't just going to earn a rate of return for lending out their assets, but they will also be rewarded in tokens, which give them a share of the revenue stream of the product. So imagine if you wanted to start up a new lending platform. It's very hard to get people to come and make deposits so that you can lend out. But if you were to also issue them with a token and to run it programmatically so the barriers to entry were very low, you might be able to attract a lot more capital. So what does this all mean for the future of money? Well, really, cryptocurrencies are finding product market fit, and that's revealing new opportunities for financial institutions. Bitcoin is rapidly becoming a mainstream financial asset, really held in a portfolio among many other traditional assets. You might have your stocks, your bonds. Bitcoin is now alongside that. But uniquely, it also offers investors a stake in future financial innovation. And I think young investors in particular are really drawn to that. And so financial institutions that don't offer them an opportunity to invest will be left behind by the fintech competition that is already getting involved. And then the stablecoins. I think their success really validates the market for digital assets. And that market will grow further if digital assets were actually issued by a trusted brand name with a global network. So far, stablecoins have been very crypto native and not issued by some entity that a household might actually know and trust. And that, I think, limits some of the adoption. But if there was to be a mainstream household name business coming and issuing a stablecoin, they should realize that if demand is like it has been for Tether or USDC or other stablecoins, that demand will come from trading exotic cryptocurrencies or indeed from access to US dollars outside of a US jurisdiction. So there might be some policies that need to be made to manage that risk. And Ethereum really demonstrates the value of rapid experiments in financial instruments. And these experiments, they currently look like money games. They look a bit silly without a real purpose. But you shouldn't underestimate what the mixture of fun, possible reward, and competition does to draw in users and drive creativity. I already think of Ethereum as the TikTok of money. You might not always know what's going on, but it's a great source of creativity. So it's really something to pay attention to. If you ever want to learn more, please go to markets.chainalysis.com, where Chainalysis Market Intel provides live data and insights on cryptocurrency use. And if you have any questions, please email me at philip@chainalysis.com or follow me on Twitter at philip_Gradwell. Thank you very much, and I hope you enjoy the rest of Singapore Fintech Festival.